we did realize there's a lot of things happening about transacting those assets, the crypto assets, which we don't recognize as currency. Because currency is that which is backed by a bank, the central bank of the country or the government of that country. So that is yet to happen in our country, and it is going to happen sometime this year. I think the biggest risk for all countries across the board will be on the money laundering aspect and also on the aspect of currency being used for financing terror. The volumes of such transactions outside of this was fairly huge. We also wanted to be sure that, and since there was no regulatory mechanism looking at them, we wanted to make sure money is being, or value of assets being transacted, if they are transacted in an unregulated environment, we were not sure if the, let us say, the FATF's money trail, as they say, travel route, travel line is being tracked at all. And we were not even sure as to how we can keep a trail following of these transactions which were happening. After all, these were electronic codes eventually. So we wanted to be sure, and therefore we did announce that on the income that is generated out of the transactions of these crypto assets will be taxed at 30%, and over and above that there is a 1% tax deduction at source, which is also imposed on every transaction. So through that we'll be able to know who's buying and who's selling it, and that 1% is not an additional tax over the 30% that I've imposed. It is only reconcilable with the 30 or with any other tax the person is expected to pay. Essentially, by taxing, we were trying to make sure that we are keeping a trail and also making sure these are going to be eventually compliant with anti-money laundering rules, and making sure that these kind of operations don't end up inadvertently to funding any kind of terror activities. So we wanted to be sure when there was no regulation happening, these activities which were becoming now fairly extensive are kept an eye on, and there should be a financial implication on them, and therefore the tax. It wasn't as if we have legitimized them. We haven't said that this is currency. We haven't said that this has intrinsic value, but certain operations are taxable for the sovereign, and that is why we've done this. The risk which worries me more on the non-governmental domain is essentially you're looking at unhosted wallets through which across the borders, across the globe, this entire operation takes place. So regulating cannot be done by a single country within its terrain through some effective method. And for doing it across the borders, technology doesn't have a solution which will be acceptable to various sovereigns, at the same time applicable within each of the territory. Again, the risks involved will have to be differentially approached, because for each user case, the risks can also be different depending on the economy that you're talking about. There are 9 countries, if I understand correct, some of which Kristalina named: Bahamas, 7 of the Eastern Caribbean countries, Nigeria. So if you were to take a case study in a case use in Nigeria, its application and the risks involved will be very different from the risks in, let's say, a tourism or investment-rich Bahamas, or any other country for that matter. So as long as the non-governmental activity of the crypto assets are through the unhosted wallets, regulation is going to be very difficult. But cross-border payments will become very effective, yes, through the central bank driven currencies, and even then efficiency, transparency, and also better management of large payments which are being done between countries, all that is taken care of. But even then, I would think we have now come to a stage. I agree with the central bank chief of Brazil that 2 years ago the kind of protocols which prevailed are very different from what it is today. Today is being much better. But even with all this said, unless there's going to be a global approach at regulating and also an understanding of the technology even as it keeps evolving, to be on the top of things and to have technology-driven solutions to regulate and monitor, not so much to interfere, but of course to keep an eye that your anti-money laundering, I harp on that very much because I think the biggest risk for all countries across the board will be on the money laundering aspect and also on the aspect of currency being used for financing terror. So it is in these two. Otherwise, I don't see a reason why innovation such as this in fintech, whose fountainhead or whose source itself is to bypass many of the regulatory. Innovation is always disruptive. I don't look at it as negative feature. It's a right feature. Innovation is disruptive. But on an essential thing of asset or valuation, which might be monetized for funding other activities which are not so savory, I think regulation using technology is the only answer. But regulation using technology will have to be so adept and so nimble that it has to not be behind the curve but be sure that it is on the top of it. And that's not possible if any one country thinks that it can handle it. It has to be across the board, and I'm sure Kristalina really is on it already.